All right, let's get right into it. Today, we're tearing apart a real-world futures trading strategy, one that's designed for a $50,000 account. The goal here is simple, to take this trader's plan and turn it into a blueprint that anyone can understand. Let's dive in. You hear it all the time, right? You've got to have a trading plan. But what does one actually look like? I mean, what are the real numbers, the hard rules, the math that makes a strategy tick? Well, that's exactly what we're about to break down, piece by piece. So here's our roadmap for today. We're going to start with the basic rules of the account, the foundation. Then we'll dig into the specific strategies for two different markets, the NASDAQ and gold. After that, we get to the really cool part, the math behind it all. We'll stress test the plan, and then we'll see how it all comes together to actually make money. Okay, first things first. Before you can even think about a trade, you have to know the rules of the game you're playing. This framework, this foundation, it's everything. This slide lays out the three most important numbers for this entire strategy. Yeah, we start with a $50,000 account, but honestly, the numbers that really matter are the loss limits. You've got a max loss limit of $3,000. If you lose that, game over. And just as critical is the daily loss limit of $1,000. Any strategy we build has to live within these boundaries. These are the hard stops. All right, now for the fun part. Let's apply these rules to our first market. We're going to start with the Micro E-mini NASDAQ 100 Futures, or MNQ. Think of it as a way to trade the biggest tech stocks. Let's get into the nitty-gritty of the position size, the risk, and the reward. So check this out. These are the core numbers for any NASDAQ trade in this plan. The position size is 3 lots. Think of lots as just a standard contract size. Now, for every single trade, the risk, our stop loss, is set at exactly $300. And the target, our take profit, is set at $600. You can already see the relationship there, can't you? The goal is to make double what you're risking. So how do those dollar amounts translate to what's actually happening in the market? Well, the math is pretty simple. With 3 lots, every single point the NASDAQ moves is worth $6. So a $300 stop loss means we're giving the trade 50 points of wiggle room against us. And that $600 take profit, that means we're shooting for a 100-point move in our favor. And that right there, that's the absolute core of this strategy. A clean, simple 1-to-2 risk-to-reward ratio. For every single dollar you put on the line, you are systematically aiming to make 2. This isn't just a nice-to-have, it's a fundamental pillar of profitable trading, and it's baked right into the DNA of this plan. Okay, so that's the blueprint for the NASDAQ. Now, let's see how these same principles hold up in a completely different world. Micro Gold Futures, or MGC, which, you guessed it, tracks the price of gold. Well, this looks pretty familiar, doesn't it? We've got the same position size, 3 lots. But notice the risk and reward are a little bit higher. The stop loss is $375 and the take profit is $750. The numbers are different, but the relationship between them, that's the key. Let's run the numbers for gold. With 3 lots, a full 1.0 move in the gold market is worth $30. So that $375 stop loss translates to 12.5 moves against us. And that $750 target, that means we're looking for a 25-point move to go our way. And would you look at that? We land on the exact same 1-to-2 risk-to-reward ratio. This consistency isn't an accident. It's the engine that drives this entire strategy. It tells us the plan is built on a solid mathematical principle, not just a gut feeling about one particular market. Okay, this next part, this is my favorite part. This is the real aha moment for this whole plan. We've got our risk, we've got our reward. So what's the absolute minimum number of times we need to be right just to not lose any money? This is what we call the break-even win rate. The formula is beautifully simple. You just take your risk and you divide it by the sum of your risk plus your reward. So, using our NASDAQ numbers, that's 300 divided by 900, which gives us 33.3%. So what's the bottom line? You only need to win 34% of your trades to break even. I mean, let that sink in. You can be wrong almost 2 out of every 3 times and still not lose money. This is exactly why that 1-to-2 ratio is so incredibly powerful. Anything above 34% is pure profit. Now, a great plan on paper doesn't mean much if you can't survive the trading day. So let's stress test these two strategies against that $1,000 daily loss limit we talked about. Which market gives us more chances to find a winning trade?
This makes it crystal clear when you put them side by side. With the NASDAQ, each loss is $300. You could lose 3 times in a row, be down $900, and you're still under the daily limit. You can still take another shot. But with gold, each loss is $375. 3 of those, and you're at $1,125. You've blown past your daily limit. So the NASDAQ plan gives you more at-bats during the day.
All right, we've seen the rules, we've done the math, and we've figured out the daily risk. Now let's put it all together and see what this actually looks like over a string of trades. Let's see how that path to profit really unfolds. Okay, here's a simulation of 20 trades using a 40% win rate. Remember, our break-even is only 34%, so this is totally realistic. And yeah, it means you're losing more often than you're winning. 12 losses to only 8 wins. But look at what happens. The 8 wins bring in $4,800, while the 12 losses only cost $3,600. The end result? A $1,200 profit. This shows how you can be profitable even without winning most of the time. So what makes a plan like this so solid? Let's just recap the key ingredients. It's all built on that powerful 1 to 2 risk-reward foundation. Each trade risks just over 0.5% of the account, which keeps you far away from that scary max loss limit. The daily plan is flexible, giving you multiple chances to find a good trade. It really finds that perfect sweet spot. It's aggressive enough to make real money, but conservative enough to keep you in the game for the long haul.
And that brings us to the final thought here. We've deconstructed this entire blueprint, and what did we find? It wasn't some magical, complicated formula, was it? It was a simple, logical, and disciplined set of rules. It really makes you wonder, is all the complex stuff we chase in trading just a distraction? Could it be that a simple, disciplined plan like this is the missing piece you've been looking for all along?